Hi, this is Josh Landau. I'm the president of the International Insurance Society, part of the Institutes, and it's a real pleasure to be with all of you today. We have a fun program for the next hour and a half here, something that we've been working on for quite some time. Here at the Institutes, we have several brands that look at the insurance industry from varying perspectives. And this is a panel that is going to focus on the insurance industry and innovation and how the three of us view the industry and the solutions that are coming out of the industry from the varying perspectives. The International Insurance Society, as many of you know, is a global organization. We're in over 90 countries, focusing on thought leadership and education in the insurance industry. And I'm going to be leading the organization, leading the discussion from that global and international perspective. I've been a banker for over 30 years. I am not an industry executive, which gives me a different perspective of the world. I did spend time in private equity investing in the insurance industry, but for the last 2 years leading the IIS as the president. Also running the financial institutions group for Fifth Third Bank, the Cincinnati-based bank, the ninth largest bank in the U.S. But spent over 10 years at Australia and New Zealand Bank, running insurance globally for the institution, and starting my career way back when at a chemical bank, now part of JP Morgan Chase. I'd like to introduce Paul Carroll and Sean Kevelighan. I'm going to read their bios, and then we're going to open it up for some discussion and questions. First, I'm pleased to welcome Sean Kevelighan to the panel. Sean is the president and chief executive officer of the Insurance Information Institute, the III. He's joined the III as president and CEO in 2016. Previously, he was group head of public affairs for Zurich Insurance Group, where he oversaw government and industry affairs, as well as corporate responsibility. He joined Zurich in May 2013 as the head of government and industry affairs for North America, with responsibility for driving the public policy agenda in the region. Prior to that, he worked at Citigroup as head of strategic communications for its global consumer banking business, and for Zurich as head of group media relations in North America. He served in various public sector posts in Washington, D.C., as a political appointee in the administration of President George W. Bush. He served in the Department of Treasury as a spokesperson for economic issues, and eventually became senior advisor for the Office of Tax Policy. Just a few more things, and again, this is important because of the different perspective that Sean's going to be able to bring to the conversation. He was also the press secretary for the White House Office of Management and Budget, and additionally worked on Capitol Hill, serving on the staff of members of Congress, most notably as legislative director for Representative Bob Schaefer of Colorado. So I'm going to pause there, and I'm going to then introduce our friend Paul Carroll. Paul Carroll is the editor-in-chief at the Insurance Thought Leadership, the ITL, a digital platform that drives innovation in insurance. He has excelled at the highest levels of journalism for decades while pushing the state of the art of business and strategy innovation. For 17 years, he was a reporter and editor of the Wall Street Journal, where he wrote about information technology. Wall Street Journal nominated him twice for the Pulitzer Prize, and he was a finalist once. He left to become a partner at Diamond Management and Technology Consultants, where he founded and edited a magazine that was a finalist for the National Magazine Award for General Excellence. He's the best-selling author of numerous books, beginning with Big Blues, The Unmaking of IBM, published by Crown in 1993. And in 2008, Paul and Chunkamoy published Billion Dollar Lessons, What You Can Learn from the Most Inexcusable Business Failures of the Last 25 Years, based on 20 researchers, 2 years of analysis of 2,500 corporate disasters. I'm going to welcome both gentlemen to the panel. And again, we're here to have some fun, talk about a number of issues that we have identified in the industry. And we're going to start it off by just first of all welcoming each of you, and if there's anything that you'd like to say before we kick it off.
Hey, Josh.
Thanks for having us.
Here.
Oh, sorry about that. Well, let's start by talking about some of the major issues that are going on in the industry today. We've talked about many that are impacting the industry in a disproportionate way. Things like deglobalization and the trends there. We're going to talk a little bit about social inflation. We're going to talk a little bit about ESG and maybe even some embedded insurance. And then how the innovations of the industry can attack and influence these trends that are only just beginning in some ways. So let's first talk about the deglobalization trend and how this is going to impact the insurance industry, how insurance companies can change with the times, given some of the challenges and the trends that are going on in the industry, in particular around supply chain. So, Sean, let's start with you. Given the U.S. focus of the III and also some of your government and policy experience, let's talk about deglobalization, some of the trends that have been happening over the last few years, in particular around supply chain, as I mentioned, with global manufacturers trying to de-risk their supply chains and what that impact is going to be for insurance companies.
Well, I think first and foremost, and good to see you, Josh, and nice to be back at the ARIA meeting again. It's been a few years, so I appreciate being here. I think deglobalization is one of those geopolitical trends where people, to your point, Josh, they're trying to de-risk themselves, but at the same time, what we're seeing right now is extraordinary activity in the likes of with disruption in the likes of replacement costs and inflation, and so that, for what it's worth, we see it continuing for a longer transition even than what the Federal Reserve says, and that's just going to weigh on the industry. Obviously, replacement costs, getting things from overseas, making sure that we can have things like construction materials, automobiles are always increasing in terms of their replacement costs, just with new technology and innovation. So it is a trend that we're seeing. I mean, we've seen Brexit, we've seen our own country here, where we're all beginning to look at each other more insular, and so that's going to have longer term impacts. I think we're going to continue to see the likes of inflation continue as well, and put a strain on the industry.
No, I agree. Paul, from a futurist perspective, where do you see this going?
So I agree with Sean. I sometimes tell people I've been watching the same movie for 35 years, going back to when I started covering IBM for the Wall Street Journal in the mid 1980s. And when you look at the long-term trend, everything was focused on radical efficiency, outsourcing, digitization, and so forth. And that trend has played out for a long time. But because of some of these things that Sean talked about, political issues, supply chain issues, the CHIPS Act, not wanting to be reliant on China for semiconductors and that sort of thing, the political environment, it does seem like we have this profound change. And instead of doing things that are efficient but risky, there's going to be a lot more focus on de-risking and making sure that we can produce things in the United States. And that's the same sort of thing that's going on in all sorts of countries around the world. So I think it's going to be a good 10-year trend, probably more like a 15 or 20-year trend, where we'll be rethinking the supply chain.
It's interesting. I've had this discussion with many global CEOs, and they're looking at it through a number of different lenses. One lens that I found interesting is this is where some of the global insurers thrive by helping their global clients navigate through these de-risking trends, helping them identify countries that are more sustainable, more will benefit or be least impacted from these changes. The insurers, because of their global footprints, have that level of insight, level of connectivity, and again, can be that guiding force through this. The other is a lot of these insurance companies really are local. They're not just, they are global in the sense that they're in multiple countries, but they still are operating at the local level and understanding the local issues, and again, can actually even add more value in a deglobalization trending world to help countries respond even at the local on the locals level. So we're some more interesting things on how we are being connected. What about?
I think there's one thing maybe to
yeah.
add there, Josh, which is that,
Sure.
that one thing with digitization is I think people can now see the risk more clearly than they could before. It used to be that you sort of had visibility maybe into your suppliers, but now the visibility is going into the suppliers and the suppliers of the suppliers of the suppliers and so forth. So, and people are thinking about more issues based on this book, $1 Billion Lessons. Chunk and I did a big consulting project at one of the major automakers a few years ago on their driverless car strategy. And as part of that, they were thinking about going to electric vehicles, and they were realizing that some of the materials they need would have to come from the Democratic Republic of Congo, for instance, which is not exactly a reliable supplier or a country that you necessarily want to be doing business with. And it just, I think there's much more visibility. And as a result, I think that the insurance companies advising their clients can be much more sophisticated and provide much more valuable advice than they maybe could have 5 or 10 years ago.
And Sean, let's talk about the government's reaction to this. Have you talked to? Have you seen any change at, say, even at the state level versus at the national level to address some of these issues and challenges?
Well, certainly, you're looking at ways to try. Obviously, the United States being arguably one of the most regulated insurance industries in the world, with 50 plus regulators, there is a lot of activity. There is a lot of just wondering how are we going to deal with this? How are we going to focus ourselves a little bit more so that we can go along with this kind of de-risking trend and making sure at the same time that we're providing what insurance does best, driving economic growth. And so that's going to be a key question as the regulators are looking as to how do we not stifle the likes of innovation. And that in large part, III being a communications-based organization, we need to communicate about this innovation that we're taking on in this industry and make sure that people understand what the results will be and what good they can be, because otherwise we do run the chance of because regulators, I always like to say, when the constituents get a little nervous, then the politicians get nervous, and then the regulators get nervous. And there's a lot out there right now about what innovation can and might do. And I think communicating about it and making sure we're very clear as an industry, making sure that we're working very closely with our regulators so that we can innovate and so that we can, in the United States at least, continue to drive a large portion of the insurance market overall.
What about capital? Let's talk about capital, because again, the insurance industry, especially on the reinsurance side, truly is a global construct in terms of the sharing of risk, both from a capital standpoint, but also from a risk sharing standpoint. Do you see that changing the appetite for insurers in the U.S. If capital is? Do you see that deglobalization trend extending to reinsurance?
Well, I think in large part, if you go into the capital, we as an industry are seeing our loss costs, in particular in the United States, increase significantly. If you go back to the 80s, you're seeing loss costs for the industry increase close to 700%. And these big spikes in loss costs as well are happening closer together. So we had 2020, I think, was the second largest year on record behind 2017, and then you had Katrina in 2005. So 9 of your top 10 loss cost years have now happened in the 2000s, with the other one happening just in the 90s. And so there does need to be capital on hand as these loss costs are increasing, and that's why, at least in the U.S., we have a policyholder surplus now of getting close to $1 trillion. So clearly, the industry is paying attention to what is happening in terms of risks, and the risks increasing, in particular around severity as related to natural catastrophes, and making sure that there's capital on hand to do what we also do, which is keep our promises. All that being said, you are seeing a tightening, if you will, on the reinsurance side of things, because in some cases they can't determine whether or not the risk transfer tool, that is insurance, is it going to be able to go as far as it needs to, right? If you look at, and this isn't just a natural catastrophe problem. If you look at the state of Florida right now, you're seeing almost every week, you're seeing insurers having to go insolvent. This is not a natural catastrophe issue. This is a social inflation issue where litigation and extreme fraud have both now created this scenario, and it's trickling over into Louisiana. But natural catastrophe related, look at what you have in California. So we do have a question as to how far this is going to go before we're able to make sure that we're underwriting the risk appropriately. And again, sometimes the politics set in there and make us artificially tamper down the rates that are needed to transfer the risk.
Let's stay on that theme of social inflation, because that's something that we wanted to talk about. And with insurers' costs and claims costs continue to rise over and above general economic inflation. And again, this is also in the state of Florida playing out right in front of our eyes. Again, preferences on really who is the best place to absorb these risks. So you mentioned contagion spreading into Louisiana. Do you see that playing out in any other place right now? I know we have building costs going up. You mentioned that earlier. Where else do you see the societal inflation, the social inflation playing out today?
I mean, it is running rampant just about everywhere in the United States right now. You can't drive through a city or town on an interstate without being bombarded by billboards for attorneys promising claims and things. So we actually are currently have a proactive public relations campaign to inform this discussion and help people understand that these flyers that you're seeing in Florida that are promising your insurance company will pay for your roof, but also going up into the states like New York, certainly California. You're having many insurers right now reconsidering whether or not they can underwrite the risk given what the political or regulatory artificial lowering of rates, is not allowing for the risk to be. That's a natural catastrophe related issue, but Florida is just a really good illustration of just what and how things can go wrong. The assignment of benefits issue, which got taken care of a little bit on the homeowner side a few years ago, still exists on the auto side of things. And so they're simply just quite honestly, the trial attorneys just are much further out of the gate than we are as an industry. And we're playing catch up, obviously. Another good example of what we saw in terms of social inflation in real time was during COVID. Trial attorneys led a business interruption scare that was absolutely unnecessary, and they were trying to convince legislators to rewrite contracts that actually would have created in a matter of months an insolvent insurance industry. So, and they have these compelling arguments. They are lawyers. They do talk for their living, but at the same time, we need people to understand that if we get some of this stuff wrong, we aren't going to have that capital or be available. That risk transfer tool that people rely on, that we know, is proven to drive economic growth, it is in jeopardy if we allow this kind of runaway train, if you will, to continue.
The thing that struck me the most among things that people write for us at ITL is this risk capital that's now being thrown at the issue. I mean, it's one thing if somebody feels like he or she has an issue and wants to raise it, but now you have this little industry, or maybe big industry, that's sort of sprung up where people will finance your lawsuit in return for a cut of the winnings. So it's not just an individual sort of thing, but there's gasoline being thrown on this fire.
Yeah, those are hedge funds, right? A friend of mine runs the Managed Fund Association. I was speaking to him last week, and hedge funds, they're not your broader, let's call them household name hedge funds or banks, right? They're these niche operations, but they're working and they're making money. I did confirm that no insurers are betting on it, but it is a big business. But we've also found in some of the messaging studies that we've done at III that third-party litigation funding is also most appalling to the consumer. So we need to make sure that people understand what's happening, and hopefully they do understand that what the consequence is when you take that plaintiff lawyer rhetoric and try and run with it.
And I'm hoping that Florida is such a a mess, such an obvious mess, that becomes a way of driving the message home. Do you want to be like Florida or not? And if you do, then, keep going down this path that you're going down.
Yep.
Look, I mean, I don't see any sign of the Florida issues slowing down. They surpassed New York as the third largest state in the country a few years ago. The net migration into the state continues to be in the hundreds of thousands every year, whereas some other states in the north, like New York, are losing over 100,000 a year. States like Texas are growing at, I think 2 years ago, added almost 300,000. But more importantly, in the state of Florida, in addition to the population explosion, the amount of building in risk areas is also increasing. So what percentage do you think of this, or how do you describe? So you have the social inflation, you have the litigation issues, but you're also having more people in places that had known issues than before. So even if we didn't have any of the social inflation, even if we didn't have the litigation challenges or issues that we have, we still have more people in risky areas than before. Even if you hold climate risk the same, and you just apply the last 100 years of catastrophes, you're going to have more losses. So is there a reason to rethink how we protect, or how we offer that type of protection? Do we need a Citizens 2.0?
Well, I don't know if it's, I think government has proven itself to not be altogether great at insurance. So I think what we need to do is focus a little bit more, one, on making sure that people get the rates for the risk. To your point, more and more people are living in harm's way. South Florida, Texas, Southern California. These are places, especially during COVID, everybody wanted to move where the weather was better, and they're staying. But at the same time, to your point, the climate risk is evolving. Texas had a freeze the Southwest country had a freeze, which it doesn't do, but every county in Texas now had some sort of frozen claim in it. Hurricane Ida, these hurricanes are actually staying inland more and more, and going up the inland side of the eastern seaboard, not just dissipating and going away. And the wildfires too. We're seeing right now several wildfires are burning and putting it out. And what we need to do is, and I think this is where the industry, in the future of the industry, is going, is we need to shift from being detecting and repairing catastrophes to predicting and preventing. And I think that's where you're seeing innovation in the likes of modeling, but also just pure information and education for the consumer, because the consumer themselves also need to change their behavior. The one we talked about, the inland flooding that's occurring. If you go to resilience.iii.org, there's an interactive map there that allows you to see flood insurance take-up rates by county. And there's a dark brown swath all the way inland up the eastern seaboard, and that dark brown color on the map represents less than 1%, meaning there's less than 1% take-up rate in that region. Along the coast, it's better. You got you'll have 40 and even 70% take-up rate sometimes along the coast, but inland, again, where you saw the likes of Harvey in Texas, or like I said, Ida going all the way up, they don't have insurance. They don't have the right type of insurance, and they're not thinking about risk. If you think about the property purchasing process in this country, it doesn't involve risk until it's almost too late. Right? When we have a tool at III now that allows you to look at up to 30 variables of risk for every piece of property in the United States, but nobody even starts thinking about insurance until, one, they go to get a mortgage, or two, if they pay cash for the house. We hear a lot of situations where they don't even think about insurance until they're in the house a couple weeks after. So how do we, one, make sure that people understand the insurance, but two, how do they change the behaviors of where they're living, how they're building? That's going to be a real key issue, I think, that's more real time. I know we're going to talk about ESG and these different issue areas and stuff, and we seem to be obsessed about carbon, which is kind of a 50-year thing happening, right? But nobody's actually talking as much as they should be about the physical infrastructure aspect of it, and how do we adapt ourselves in a physical infrastructure sense so that we can actually live in these places in a less risky way.
The modeling is what I've seen that gets me the most excited. I think people are getting much more sophisticated about the modeling. It used to be, are you in a floodplain when you buy a house? Well, yeah, maybe. But there are other things that can affect that. I mean, if you're in a floodplain, but Sean's house is 20 feet higher up the hill than mine is, then I'm a lot more vulnerable than Sean is. And people are getting more sophisticated, not only about the elevation sort of issues, but there's some people who will take a look at an office building and not only say, is it vulnerable, but okay, where do you have your computer equipment? Is it on the ground floor? Is it on the third floor? Is it on the front of the building where it's going to be exposed to the wind and the rain? Is it in the back of the building where it's going to be more protected? And it's one of these things that'll take a while, but there is some really sophisticated work being done on modeling, in particular on flood, that I've seen.
Why isn't market forces, specifically pricing of insurance, driving behavior? Is it because of what you say, because it wasn't front of mind, because it wasn't part of the purchasing process? And do you think it's being intentionally avoided because it's an uncontrollable cost? So it's just part of moving to Florida that prices are going to be higher.
Well, I think on the commercial side, it's less of an issue, and we're in a hard market, if you will, right now, because on the commercial side, in particular, on the personal side, it gets political. Right? Politicians do not like to have to tell their constituents that they need to pay higher rates for insurance. That just doesn't go over well. It's not what gets you votes. And so as a result, you have several efforts where when you're trying to price the rate accordingly, the regulator may say no, really for political reasons, more so than anything else. I think California is a great example of that. Certainly, Florida's trying, and we're seeing some of that rate increase happening. But even if you look at our national flood insurance program, where this risk rating 2.0, you can tell the rhetoric already is looking at ways to tamper down the increasing rates that are coming along with it. But look at the devastating flooding that we have going on right now in Kentucky and around the country. St. Louis last week. We've got these 100 and 200-year-old floods everywhere, and people don't have the right amount of insurance. And even if they do, it's artificially, the lowered rate because of politics. So I do think politics plays a big role in terms of people not paying the rate that is what the risk is.
Yeah, I live in Northern California, not really in a wildfire zone, but close enough that some years it'll be pretty gray outside because of the wildfires, and was amazed to hear the governor say, well, we won't let prices rise too much. We're going to cap them for the consumer. And I thought, well, that's not how you send the right signal on risk. My colleague Tunkamoy will often say that people may think they have a 30-year mortgage on a house, but you really have sort of a one-year take on the house because it depends on your insurance rate. And if we get to the point where the insurance rates are sending the right signals, then I'm hoping that it'll drive consumer behavior, but I'm not overly optimistic that that'll happen anytime soon.
I'm going to take a negative and try to turn it into a positive here, because again, I want to link it back to innovation. One of the other issues with this is fraud. Fraud, actually, before we started talking over the last few years about social inflation and litigation, fraud was among the biggest contributors to higher premiums and costs. But there are a lot more tools available to us today than there's ever been before, because of the digitization of insurance, because of surveillance technology, the ability to deploy drones quickly in disaster areas, the ability to have simple tools that are freely available, like a Google Earth, to check to see what was there and what was not there before and after, to mitigate that. On the consumer side, obviously, there's wearables in the auto sector. There's technology that is now second nature in terms of understanding the velocity of a vehicle, the direction a vehicle is traveling. All this information that makes it even harder and harder to permit fraud. Do you see that coming down in any way, or do you see anything, any positive towards some of these new innovations with reducing that? And that's for either one.
Certainly, the innovation and really where at its core is meant to enhance the customer experience, and we are seeing that, right? When people do appreciate when the drone gets up and gets their claim paid before anybody can even get on the ground, for example, that's an enhanced experience. Or being able to take a picture of your car and send it in automatically after an accident. These are great innovations and happening, but they also get met with questions, as I mentioned earlier too. So we've got to figure out ways to communicate and make people feel better about the innovations that are happening. I mean, telematics, for example, is still not really picked up like you would have thought in the auto world, because people really don't want insurers to know how they're driving. They'd rather kind of guess about it. But I do see that innovation, as it increases more and more, I think it's focused more on enhancing that consumer experience. And when that's the case, I think that's gonna improve the relationship between the insurer and the customer. Quite honestly, it gives the insurer more time to deal with the customer, as opposed to pre-innovation times where it's just a lot of paperwork and not as efficient as it is today.
So I think that there are a lot of things that are happening that will reduce fraud, but at the same time, it's sort of like squeezing a balloon. Things are just going to move around to some extent. I did a book recently that includes a concept I talk about a fair amount that we call the laws of zero. Basically, if you're planning for the future 10, 20, 30 years out, you can assume that computing costs are basically free. I mean, you just ride Moore's law down. Communication costs basically free. And we talk a lot about information as well, where you not only have this increased computing power and the communication capability, but you've now got little satellites that are just all over the place. So, as Sean says, you can track all kinds of things, see what was there before, see what's not there. You can, see whether there really was damage in the storm to the roof or whether that damage was there ahead of time or whatever. There are all sorts of sensors that you can actually put in your body. You can swallow something about the size of a grain of rice, and you can wind up getting information on blood sugars and things inside you that were never possible before. And based on that, some things like authentication of identity are going to become much easier. If you just have to steal my password, that's one thing. But if you have to then be able to deal with the fact that I have my phone and you can send me, there are just all kinds of things that can happen. But at the same time, there are new kinds of fraud that conceivably can happen. One of the things that struck me the most when we did this consulting project with a big automaker is that cars are taught don't run over people. Great, right? But what happens if somebody stands in front of your autonomous vehicle? You can't go. So you can basically carjack something just by having somebody stand in front of the car and have somebody stand behind the car. There actually was kind of a famous story a few years ago of somebody in a Tesla who had it on auto, what do they call it? The autonomous driving, and fell asleep drunk in the middle of the night going up 101 in Silicon Valley. And a police officer saw that the person was drunk and asleep, guessed what was going on, called a couple more police, and they got the car to stop by just having a police car pull in front of it and slow down, and having two cars beside it so it couldn't go anyplace. So they stopped this guy's car and arrested him for drunk driving. But anyway, there are lots of things that are happening that can attack the traditional sources of fraud. But as you wire the world more and so forth, you're also creating opportunities for these people who make a lot of money at fraud to find new things to do.
Yeah, and of course, the counter to fraud is what we've been talking about before, which is litigation, right? It can maybe tamper down the fraud, but the litigation and the desire to litigate in this country right now is just continuing to accelerate and outpace what we predict as an industry in terms of the like of the impact, in particular in auto. There hasn't been a year in the last decade where we've been able to really underwrite personal auto or commercial auto, and a lot of that is underwritten or make profit in any way. The combined ratio for commercial I think last year was the first year that it even fell below 100 in the last decade. That's very similar to what you saw in personal auto. Personal auto dropped during COVID, but it shot right back up the next time around. It's one thing that people are also driving more dangerously, but the counter to the fraud, which is you see a lot of fraud in auto in itself, and if you've got innovations that can curb it, I think we've also got to figure out how we can curb the litigation side of it too.
Let's shift this in terms of how other countries are dealing with these similar issues. We talk about the litigation issues. Is that a U.S. phenomenon? Is that spreading to other places? And when you talk to Sean in particular, the U.S. Government in your various discussions, does that come up at all? How other countries are addressing the same issue?
It's certainly, much larger here in this country than most any other in the world, right? And you can look at an issue even like climate risk. Climate risk was very hard for people to talk about in this industry for some time. And in large part, it was because of the liability factor. There was a legal liability, so you would have, and then you had a bifurcation of people's for Europe, I guess, versus the U.S. and how it embraced climate risk differently. Of course, we've got a real opportunity when it comes to climate risk to try and help, like I mentioned earlier, help rebuild and find ways to predict and prevent and adapt to this through the likes of physical infrastructure. But we're a little behind now on trying to make sure people understand that and understand why insurance is different. But I do see that the litigation in the U.S. is really out of control in comparison.
Okay. This is absolutely fantastic, and we can go on and on about it, especially the continued trends on deglobalization and social inflation. But let's shift it a bit and talk about ESG. This is a topic that continues to be talked about at the highest levels of organizations. You can't read the chairman or CEO's message of any insurance company around the world about them talking about what they're specifically doing to address ESG, and whether that's on the environmental side, on the social side, or on the government, social equality, or on the governance side. Let's talk first a little bit about where you see the balance. Where do you see the insurance industry's impact, at least recently, on ESG? Do you see insurers focusing disproportionately on any one of those segments? Let's first start to talk about that. Well, Sean, we'll start with you.
So I really think, and we at AAA have been saying that ESG is actually in insurers' DNA in large part. So if you look at the environmental, we've been talking about that already in terms of the climate risk and what we've been seeing in loss costs, and paying attention to it and trying to help manage our customers manage through this climate risk. Innovation, of course, playing a key role in that. Great investments in innovation that is helping what Paul mentioned around modeling and things like that, so that we're trying to help society. And that gets into the social part of it. If you look at what insurance does to improve societal good, it's remarkable in comparison to other industries. We've got AAA is a nonprofit set up to be a trusted, objective source of information for consumers and industry professionals and policymakers. But we don't sell insurance, and we don't lobby as an organization. You've got the Institute for Business and Home Safety down in South Carolina that spent $30 million to build a wind 30 square foot or 30-story wind machine to recreate hurricane strengths, or the likes of the IIHS and what it's done for highway safety. So a lot is being done in the insurance industry for societal good. And then governance in particular, and I think this is where on the ESG front, we've just, and you're seeing people in discussions right now as to whether or not this ESG phenomenon got a little too fast for itself. In particular, for insurance on governance, I mentioned, the U.S. insurance property casualty industry is probably one of the most regulated industries and governed industries in the world. We've got an own risk solvency assessment process so that we make sure that we stay solvent. We can weather ourselves through different economic ups and downs and different things like that. So we're very well governed, but what we also have to do is just explain to people that this is all happening. I think the next step in ESG that we're at III are at least focusing on is being responsible about this, because you're sometimes the insurers and other companies are falling victim to those that are being more what I'll call activists, climate activists, and as a result, that some are making transitions that could do more harm than good. There was a story in the Wall Street Journal this weekend about the energy crisis that we're creating, and in some cases, it's because we're trying to shift too quickly to on the fossil fuel side. We don't have those alternative energy sources ready right now, so we've got to be responsible in our transition here, or it is going to have severe impacts. I mean, you only have to look to Ukraine and Germany and Europe about what happens when you shut off fossil fuels overnight. So a lot is being done in a good way about insurers. I think we have a great story to tell, and I also think we have a story to help neutralize some of this, what I called earlier, obsession with carbon, and focus a little bit more on physical infrastructure resilience.
Yeah, I find ESG to be a funny one. I've done some work in particular with some partners at PwC on this, and they talk about what they call the CEO's dilemma, because a lot of people are believing in ESG. It's something that really began in Europe and is coming to the US from Europe. And people say, oh, ESG is great. But if you talk to investors, they did a study and found that 80% wouldn't take more than a 1 percentage point haircut on their returns in return for having a company that was really serious about ESG. And about 2/3 of that 80% wouldn't take any haircut on their return. So there's this thing where people are sort of talking about motherhood and apple pie, and they want to be involved in ESG, but it's not entirely clear to me how strong the commitment to it is at this point. The argument that I've seen people try to make, and this is really just sort of on the general ESG side, not so much exactly how insurers can play in this. The way the consultants are trying to sell this idea is that you can make money off it. So you don't just defensively say, okay, we're going to be more responsible to society or the environment and so forth. But I did a project a little more than 10 years ago at the Department of Energy, led by a McKinsey guy. It wound up leading to a book called Resource Revolution, where he and another McKinsey partner argued that what was going on with the environment was actually the biggest business opportunity in a century. And that what you really ought to do is go try to find things that would revolutionize batteries or whatever. So I'm not disagreeing with Sean on the pace of all this, but if you can do something like be identified as Tesla, which only has about 1.5% of the global market on vehicles, but is worth more than all the other car companies in the world put together, or at least was the last time I checked, then you can have opportunities. So anyway, I think ESG is really kind of uncertain at the moment. Certainly insurers can play in terms of getting people prepared to harden against whatever is going to happen in terms of the climate, and also to be more responsible, in particular on the governance side of things. But I haven't quite in my own mind decided just how serious the business world in general really is about ESG at this point.
Let's bring it back to the insurers. The insurance industry really has an impact on ESG really through two ways. One is through what they insure, what they don't insure. And then the second is the disproportionate amount of capital that they have to deploy to invest in industries, or again, not invest in an industry. Through our research at the IIS, we determined that there's no single, even total collaboration of governments around the world, which is difficult enough on social issues, to respond as quickly or as in an agile way as the insurance industry. It's unprecedented. The insurance industry collectively can make a non-governmental influence decision about a particular asset class or industry, given the vast amounts of trillions of dollars that they control. Do you think, as a result of that, regulation needs to step in and provide more guidance to insurance companies in terms of mandating that what they can and can't invest in? Do you think that regulation is that more regulation is going to occur as a result of that the insurance companies can unilaterally change an industry?
Well, I think they're certainly trying in terms of putting new regulation. From what I understand, the Biden administration has somebody appointed on the climate subject matter throughout every single office and department and throughout the administration. And you've got the SEC right now being really the first horse out of the gate, trying to talk about this through disclosures. One thing we're trying to make sure is very clear is why, when we have these kind of movements, if you will, do we almost knee-jerk reaction turn to new regulation? Why don't we look at what we have existing and determine if we've already got what we need, and if it's happening in the right way? For insurance, that's something that we do spend a lot of time at III just making sure, especially at the federal level, because it's not a federally regulated industry, helping them understand the difference of insurance. One, recognize its role and the important role it plays in economic growth and sustainability, but then also just understanding how we are investing. You mentioned we're an investment powerhouse. I think we've got close to $9 trillion overall in the industry with assets under management, but the majority of that is in fixed investments. So when we're falling victim to the likes of a group called Unfriend Coal, we have to ask ourselves, one, is that responsible just to try and get an industry not to underwrite a source of energy for Americans right away when we might not have the alternatives ready to go? We've got to make sure that that's clear as we're trying to make this carbon transition, but that's a longer term issue. And then I also think in large part, we need to make sure politics sets in, and the politics tends to focus on these ways that we need to make declarations, and I think net zero and things like that. I think we as an industry, because of what we do, we manage risk. We have an opportunity to help the communities and government better understand the solutions that need to happen in terms of adapting to what's happening with climate risk right now.
Yeah, and in my travels, I have certainly seen the value of breakthrough innovation, but I've never really seen social impact investing work. I mean, it's well-intentioned when it's done individually. It tends to get worse when the government gets involved and mandates it. To me, it creates inefficiencies in the market. And, I'd rather have people out there investing some money into something that's going to take the market by storm and make people want to do something rather than requiring that you get out of coal or oil or whatever.
And, the energy companies that we're talking about trying to restrict investing on potentially, or making sure that they're disclosed in a certain way, these are often the businesses that are investing most in new alternatives and carbon reduction. So it is asking yourself what's really responsible when we're talking about investment regulation.
And there are some doing clever things. I forget the name of it at the moment, but there's a Finnish quite large oil company that is being very forward-thinking. Among other things, they have a deal with McDonald's, at least in parts of Europe, where they go collect the oil that's used to fry the French fries, and then they turn it into fuel for vans in various places. So there are lots of companies out there doing clever things, and I'd much rather focus on the innovation than on requirements.
Yeah. And then let's talk about insurers just as employers. I mean, the insurance industry is one of the largest employers in the world, generally after government and in some cases education, given the vastness of the industry and its importance and its impact. How much of this do you see insurers doing the right thing just as as an employer, making it a more attractive place to work, giving a sense of purpose to its employees by leading on the governance side or leading on the societal equity side with diversification of boards, in addition to whether they're insuring or not insuring sectors, or whether they're investing or not investing. How much have you talked to people about just insurers as an employer?
You know, the insurance industry has really a remarkable opportunity. We know from data and information that the likes of climate is on the minds of the younger generation, and they're worried about it. And we've talked here today about how insurers are really helping manage this issue, manage this risk, and present solutions that are going to help society adapt. And I think that's a real opportunity. We know from studies that we've got hundreds of thousands of jobs that are coming available in this industry. And so, and we're right at the forefront of doing good for society, which again is important to younger generations. Let's make sure that they know about that. Let's make sure that we communicate to them of what we're doing and how we're doing it. And then also focus in on what the larger problem is. I do think right now we've got pockets of activity in the talent space and trying to focus on, insurers trying to focus on getting new talent. Bringing the industry together on the talent issue is going to be really important. We could take a lesson from the accounting industry back in the 80s. It was also suffering from a talent shortage. And they really do, as an industry, come together on campuses and things like that to make sure that they're trying to help people understand what the career in insurance is. I mean, we do a lot of good. We've talked about the good that we do as a whole for society. We build economic growth. We're first on the ground to rebuild economies and things. So I think we have an opportunity with talent generally because we need it. But I think we can also start talking about ourselves a little bit differently, and even just being proud to talk about ourselves at all. Most people don't want to talk about working in insurance because they know that it gets, an image of Ned from Groundhog Day, chasing after everybody for a life insurance policy. We are doing so much good. I'm preaching probably to the choir here because we have insurance-based academics out there, but the amount of opportunity in different ways. We've talked about, asset management like you have, Josh, right? We've got marketing, we've got accounting, we've got underwriting, all of these things. You can take a career path in insurance and go just about anywhere. I just think people need to know that.
I'm always amazed at how apologetic people are about being in insurance. They'll always talk about how they never intended to be in insurance and they just kind of fell into it. I tell people that I chose insurance. I mean, I had a career in journalism, did a bunch of stuff at the Wall Street Journal, worked for this consulting firm, did books on innovation, and then about 10 years ago, thought, okay, what hasn't really been hit by digitization yet? And decided there were 4 areas: government, healthcare, higher education, and insurance. And when I met somebody who had started ITL as a way to pull together smart thoughts on innovation and insurance, I thought, that's where I want to play. I think I can have an impact there because of stuff that I've done. And I've never understood this sort of inferiority complex because insurance does have this great noble purpose. This is the time to be there. When I talk to people about innovation, they talk about how it's important to be playing in the right sandbox, right? If you were involved in personal computers back in the early 80s, that was the right sandbox because all kinds of things could be happening. And insurance is a place where all kinds of things are happening at the moment. So I'd say, shout it from the rooftops.
Yeah. Your point about falling into it, I too was able to choose insurance. It was 2008. I was surrounded by a bunch of economists who were predicting things weren't going to be going so well. And I was about to enter into the job market at the end of the administration. And I had an insurance company call, and they explained to me how their company and most other companies were going to weather the financial crisis just fine, based on how we invest to keep capital on hand and other reasons. And we did. But I also think what happened is we got lumped in with the banks because of one particular situation. And then literally you would see that this industry began to want to fight more for the market share than come together and talk about themselves. And that to me was a bit of a miss. It was also one of the reasons why I wanted to have this role that I'm in, because I think we can communicate. That's why we're focused right now at III on the climate risk issue and proactively communicating about it so that people understand the difference that insurance is, the good that it's doing, the opportunities that it has. That's important for us to understand and inform so that they do get it right this time and they don't just lump us in with the banks.
Yeah, and I'm glad. I think this is a good transition before we open it up for questions, just to highlight for this audience what we're really trying to say here, and hopefully people understand that. First of all, I appreciate that we're all being unapologetic about being in this industry and recognizing the disproportionate influence that this industry has on helping society move forward, and whether, again, it's the influence it has on where people are going to live or not live in the future, where people are going to, how, not only where they're going to live, but how they're going to live, how the insurance industry can impact societal change, how it can impact environmental change. And again, it's the massive amounts of investment that they have, the ability to provide that risk capital, that ability to help companies that are changing their behaviors, whether it's through deglobalization and de-risking of their supply chain, whether it's through understanding social inflation and how the industry can play a part in mitigating some of the challenges. Some of these challenges are not going away. The litigation reform, that's not going to change anytime soon. Climate change isn't going to change, but it's how we deal with it. It's how the industry deploys this capital, deploys this resource of allowing people to continue to grow and thrive. And hopefully we do get to influence people's behavior differently because of that. And they start using the cost of insurance or the inability to insure as a variable in how they behave and where they live and how they live their lives. So this has been an excellent discussion. I'm really excited to hear what type of questions that the audience may have, and take advantage of the three of us. Again, we didn't talk too much about the international arena of insurance through the IIS's background, but I think that this was appropriately focused on the U.S. given this audience, as well as the influence that the III has and the ITL has, and also how influential the U.S. is on the global insurance stage. It still is the largest insurance market. U.S. companies are still deploying capital around the world, although they've disproportionately started reinvesting more inside the U.S. than in other high growth areas, partially because of deregulation, tax reform, infrastructure investment, the deglobalization trend that we mentioned. But it is important to recognize the scale of the U.S. Insurance industry as well. So why don't we take a pause there, and we can hand it back to the room and to see if there are any questions, and we can continue the dialogue.
Good. Thank you, Josh. Go ahead and open it up for questions. If you have a question, there's a mic here in the center of the room. Please come to the mic and ask your question so the speakers can answer. So as we're gathering our questions out in the audience, just a couple from my end. This industry, the insurance sector, is one that's been slow to innovate. And I think, Paul, you indicated when you come up with your list of potential industries to think about, insurance was there. Do you see this as an industry that must innovate or die? Or is it one that, as you talked about, Paul, where the transaction cost going to zero creates opportunity for the small player to continue to play in the space in a way that you don't have to have scale that you traditionally have within an insurance sector in order to survive? So it's a two-part question. One is, do you think innovation is here? It's an industry that's been slow to innovate because it really hasn't had to across time. Well, now it's one that is facing innovation pressure. You see that we're in a innovate or face consequences type of world. And the second part of the question is, does innovation give opportunity to niche players, to smaller players in market that they don't have today?
I'm sure I'll take a first whack at that. Actually, I'll start by underscoring something Josh was saying. You know, we talk about talent and everybody thinks Silicon Valley is cool and insurance is not. But in fact, no innovation happens without insurance, right? I did a book some years ago about driverless cars. Actually got a ride in one of the early Google driverless cars back in, I don't know, 2014 or something like that. And people sort of think, well, Google has all the money in the world, they can do what they want. But I assure you, Google is very thoughtful about what the risks are. They have a very smart fellow named Lauren Nickel, who's the director of insurance there, and he's quantified things and made every part of Google that's doing these moonshots and so forth defray the risk in some form. And it may be that Google decides it's going to take the risk in some ways, but in other ways it lays off the risk. So I don't think insurance is ever going away. I mean, the world can't function without some ability to transfer risk. So I think insurance is very safe. It has been slow to innovate. My mantra from day one has been, let's burn all the fax machines. Because there are just, too many things out there that are still not nearly as efficient as they could be. As far as whether this creates opportunities for small players, it does, I think, if you're smart. It's turned out that the insurtech movement has not been the upheaval that some people thought it would be 7 or 8 years ago. It's not like Amazon came in or somebody else came in and just completely redid the business model. The insurtechs have turned out to be more what we used to call armed suppliers in the early internet days, because if you were Sun Microsystems and selling servers, it didn't really matter so much exactly what business model worked, because you were selling a lot of servers, and insurtechs have done that sort of thing. My view of the world is that it's going to be based on what are called APIs, application programming interfaces. So things will become modular, I think, in the industry in the same way that the apps on your phone are modular. People don't have to write all the software. They can just say, I've done this. Now I'm going to grab the piece of software that writes it to the screen. I'm going to grab the calculator. I'm going to grab the whatever, and you piece things together. So I think that while insurance historically has been very vertically integrated, it's going to become much more horizontal. So the best claims piece will get plugged in. The best, underwriting will probably still be the secret sauce at companies, but a lot of other things are going to be sort of spread around. And the big companies certainly have an advantage, but for smart, small companies, there still are lots of opportunities. So long answer, but anyway.
Yeah. I'll add to that in terms of what I like to say is that insurance is really the only purely informational business out there. There is nothing tangible in insurance. It's a concept, and you have to trust the concept. And it's always been that way. If anything, we're no longer even physically collecting funds. We're moving ones and zeros from one machine in the cloud to another machine in the cloud, maybe sometime in the future. I think as we continue to have computing power grow exponentially, the ability to do data analytics and apply it across the insurance industry is going to continue to transform our ability to insure people. We didn't really talk too much about embedded insurance, but one of the things that I like to talk about is real-time insurance, actually insuring things at the moment, using information that has been embedded in gathering at all times, such as, and you're right, we haven't really innovated. And part of the reason why we haven't innovated as fast as other industries is by design. You want to make sure that an insurance company is going to be there when you need it in the future. The theory being that if you innovate too much, you don't want to risk that capital and that foundation that could put in jeopardy the insurance company not being there in a year, 5 years, 10 years, 50 years when you need it. So you want change to be incremental, not monumental. But there are absolutely things that on the margin can change. Why do we still have annual policies? And look, an annual policy was put in place because there was a lot of paperwork involved. There was a lot of contact that was necessary. So you wanted to do it as infrequently as possible, but still frequently enough to recognize changes. Now we can do it instantaneously. All of us, none of us right now, I'm hoping no one right now is participating in this while they're driving. Maybe there's 1 or 2 people who are driving right now. But if I'm going to make the assumption that most of us are not physically driving, but if we all have a car and have auto insurance, we're not using that auto insurance right now. So why are we paying for auto insurance that we're not using? Because right now, our insurance companies can all tell when we're in the car and when we're actually moving and how fast we're moving and what the weather is where we are and what the tire pressure is in our car at that moment and what our heart rate is and what our blood pressure is and what our temperature is and how much alcohol we have in our bodies or how well we slept the night before. And all those variables can actually determine, can make a prediction so much better than we have ever had. But we've always had information. It's not the innovation of using it, of gathering information. It's how we use new information more efficiently and effectively. And I'm excited about where this is going in the insurance industry.
And maybe even how we're using it together. To Paul's point about, you can't have innovation without insurance. Insurance has been in the middle of every single industrial revolution. And I think the World Economic Forum was the one who said that we're now in the fourth industrial revolution, right? Where cyber and physical space are meeting. At that same time, if you look back at the third one, when electronics came in and information and data was getting into the computer side, the industry actually went proprietary on a lot of that in terms of its technology. And what I think we're seeing different about this innovation cycle with the industry is actually joining forces a little bit more in the form of standardization. At the institutes, which all of us here on this panel are part of, they've got two collaboration efforts for industry standards. One, RiskFrame for blockchain, which I think can do incredible things for the insurance world, especially at the commercial level. To also having standards on modeling, so that again, let's not look as much at the proprietary side of it, and look more on ways that we can standardize it, so that we can actually be more efficient in our innovation. But there's no doubt that the industry is in on innovation. 6 years ago when I started here, it was whether or not innovation is a threat or opportunity, and I don't think there's any question about the opportunity that is an innovation. I spent 2 weeks ago in Madison, Wisconsin, an American Families Incubator, and all the companies that they're starting up on innovation and embracing it. They're even taking companies not to just benefit American family, but they're putting them out to sell products to the broader industry. Similarly with State Farm, I was in Bloomington last week and visiting with State Farm, and that's again going back to from the detecting and repairing to predicting and preventing. State Farm is giving out tools right now that you can plug into your house, and they're giving them out for free. Plug a tool into any socket in your house, and it can detect if your wiring is correct, right? So innovation is improving that value chain and improving the customer experience.
Just another question related to this innovation called the catastrophe model, or just modeling in general. One of the things that's attributed to the growth and success of the catastrophe bond market, as an example, is the insurer's acceptance, the reinsurer's acceptance of catastrophe models, and then the innovations and improvements within the cat model space. Paul, you talked about these models continuing to advance, talk about the increasing granularity that we can do within this modeling space. And so then it leads to the question of, how do we underwrite with this additional information? So I guess, again, another two-part question is, do you see the modeling going forth that you see continuing ability to be more granular in our evaluation of expected loss with some acceptable degree of accuracy? And is there a limit for that as we look forward to modeling? And the second, coming back to you, Sean and Josh, is how do we embed that in our underwriting? Because then you're taking, modeling process at the aggregate, and you're drilling that right down to an individual's home or business and making a decision of whether to accept or reject an application for insurance based on an expectation about loss that's coming out of a mathematical model.
So I'm not sure I have a lot to add on the granularity. I do just see these models not only becoming more accurate, just because the supercomputers are getting more powerful all the time. They're able to take more things in. For some reason, the European model on hurricanes has been more accurate than the US model has been for a while now, but people are always tinkering, and they're able to predict more accurately. In some cases, they're able to give a warning in particular of tornadoes, and get people out of there so they can prevent some loss that way. But to me, the main thing is this: the elevations. You can have remarkably sophisticated measurements done by satellites these days, so you can figure out the age of a roof, the vulnerability of a roof, that sort of thing. So I think it's just sort of pressing on all points, getting more granular, and using that to then inform the underwriting process and even the customer experience. Well, one thing that I hear people talk a lot about is the fact that insurers tend not to really communicate with their clients. They do just send that annual bill that Josh was talking about, which isn't a great way to have a great relationship with the customer. But if somebody's warning me that a storm is coming, hail, and I better make sure my car's in the garage or whatever, that's the kind of thing that I think becomes possible as these models get better, and can change a lot of things about the insurance process.
I absolutely agree. And look, we take property. You used to buy a house, and when you look at your application, and it would show what the distance from the nearest fire hydrant or the nearest fire department is, as a determinant of how fast, if your house caught on fire, could they start extinguishing it, so you can calculate that. That was really the limit of data that was available. But now you can triangulate, as Paul was saying, much more information about surroundings and add all these extra variables. And it's not something that any individual can do independently. I think the whole concept of augmented underwriting, I think, is really going to continue to evolve, where you have an individual looking at their traditional variables, but you have all this technology giving you all these correlations that were always there, but you just couldn't see them. And that's going to enhance the underwriting process. And I believe that I think that the communication is spot on. I think that it's not just in property, but I think in life and health, given the amount of information and wearables that you have. If I'm out going for a long walk and my heart rate based on the last couple of months is something is wrong, and then my watch clearly knows that something is wrong, alerting me that I should take a break, or maybe that there's something even worse, and informing me well in advance of anything that's detectable by myself that this information has. So, and I think Sean mentioned it even earlier, it has to do with predictability and prevention rather than remediation afterwards. And that's going to change how we behave, and it'll change behaviors. But the one thing that we didn't talk too much about is privacy and information privacy. We touched a little bit about people not wanting their insurance companies to know where they are, how fast they're driving. But what we have seen is that there are a lot of, if you incentivize people the right way, you actually can gather this information if it's done in a responsible way, and if the benefit is directly tangible, whether it's in the form of rebates or lower premiums or longer lives. So I think that the insurance industry has to do a better job of incentivizing people and demonstrating the positive benefits, while also going above and beyond to demonstrate privacy, and that they're not going to be sharing that information for the wrong purpose. For example, to sell more stuff. If my insurance company is tracking my heart rate because it sees that I'm doing more exercise, I don't want to get an ad for Nike that I need new running sneakers, because you can see how far that can go, unless you opt into it and you like that kind of thing. But
yeah, transparency is going to be key in communicating, and people feeling the value. I mean, people are concerned about variables. We did an interview with the local affiliate in New York on CBS, and it was about social media being a variable in underwriting. And within a day, that story made it to the Drudge Report, because people went to that story and were so concerned about it. So we do need to, what I call, create a two-way street on this modeling and underwriting. The sophisticated side of commercial insurance has been doing this for a long time. Having the likes of a risk engineer working with companies if they're building or doing different projects, so that you can make sure it's it's really a win-win part of the relationship, right? If you can help them understand how to better predict and prevent disaster, and nobody really benefits from that claim happening. So the more and more ways that we can make this underwriting and modeling a two-way street where the consumer sees the benefit, I think that's going to be the big win. But to Josh, your point is crucial. We've got to be transparent and we've got to communicate about it, because we don't get the trust, even unfortunately, of the likes of a Google, who's inside of everything of ours, right? But insurance just isn't going to get that opportunity like a Google does.
Okay, thank you. We just have a few minutes left. Let me finish with this, and we haven't talked about this, but if I were to ask you, what is the burning question from where you're sitting? Because this panel brings a very nice diversity and perspective of risk in the insurance market and insurance space. And so we have researchers, a room full of researchers here thinking about important questions. Would you have any advice as to the type of question you're thinking about on your side that would be worthy of having some effort put into it?
That's a really deep question.
Yeah, I'll take a stab at it. I'll come back to some of the themes that we were talking about earlier. What is the insurance industry's responsibility in driving societal change if governments are not going to act in a coordinated, collaborative way? And that could be anything, whether it's climate risk, whether it's social equality, because again, getting back to the disproportionate influence that the industry has with the vast, the $9 trillion of invested assets, plus the ability to underwrite or not underwrite certain things. What is their responsibility of coming together to make the world or change the world in a way that governments can't together or won't?
One of the questions that we have, and we've covered a lot of these, whether it's climate and public policy, but a burning question right now for this industry, and we touched on it in this conversation, is around talent. And obviously this group is in touch with that new generation of talent that we need so desperately to bring into the industry. What is the best way to do that? We're asking ourselves that question. And how can we also ensure that this talent actually represents the communities where we work and live through diversity, equity, inclusion? How can we bring that into the fold? I mean, given the large gap of talent that we have right now that needs to be filled, that seems to me to be a really good opportunity for the industry to lead on. The question is, how is it going to be most effective? And I would love to hear from this group at some point on that.
Okay, thank you.
I'm not sure I have a lot to add, but to me, the burning question is this one about how you switch to prevention. I mean, there's a lot that has to happen behind the scenes, not only to aggregate the data, but to put it in front of people at the right time. I'm still mad that the one accident I've had in my life came on black ice when we lived in Tahoe, and it turned out that was a known danger, but I didn't know it as I was driving along in what I thought were roads that hadn't had any snow in 2 weeks at dusk on a spot where water flowed over the road and black ice formed. So if somebody had somehow figured out a way to tell me about that right as I was going around this curve, it would have saved me a significant scare and a lot of money that I had to spend to repair the truck. So anyway, just that whole idea of how you switch from having all this data on the back end to turning it into something that can prevent risk, I think is the big thing I think about.
Okay, super. Well, we're at time. Go ahead and please join me in thanking the panel for joining us today. Thanks, folks.